The Corporate Governance Conference is an important contributor to the investment landscape in Saudi Arabia. During this conference, we announced the results of our Corporate Governance Index, where we rate all listed companies on Saudi Arabia's premier stock exchange, Tadawul, from a governance perspective. This serves to improve market efficiency and aids investors in their decision-making process. This year, we are hosting a hybrid conference with limited in-person attendance due to precautions related to the COVID-19 pandemic. Nonetheless, we are pleased to have two very prominent keynote speakers from the London Business School and from the University of California at Los Angeles participate via Zoom. The theme of this year's conference is ESG investing. This stands for environmental, social, and governance. It is an increasingly important topic where institutional investors that include large pension funds and asset managers are applying ethical and sustainability criteria to their investment allocation. This is a positive trend, and corporations need to increase their awareness and sensitivity to this investor-led movement.
All right, assalamu alaikum everyone here and far away in Zoom. Bismillah ar-Rahman ar-Rahim wa salatu wa salamu ala Rasulih al-Kareem. I want to apologize for you for not starting at 6 o'clock sharp because, as I said, there were some issues here, even though they were ironed out this afternoon, but somehow things happened. All right, Your Excellency, Dr. Muhammad Al-Hayazim, and honorable executives and managers, our esteemed speakers, my colleagues, and all our colleagues who are participating through Zoom. Assalamu alaikum again. We are living here the traditions which we used to for the last 5 years, namely this annual event. We would like to continue this annual event no matter what the circumstances are. Last year, we started, in fact, a new history in the era of the corporate governance in Alfaisal University, and that we expanded it to make it international. And we had last year a full day of activities. The daytime was for research and papers and practitioners and so on, and the evening was for the keynote speakers, the Corporate Governance Index results, and the Excellence Awards for the Corporate Governance Index. We wanted to do this year, but again, as they say, the wind blew against the sailor. So, but at the same time, we'd like to continue. And with the support we received from our president, Dr. Al-Hayazim, we decided to continue, but in a truncated form. So the day program, unfortunately, we could not run it due to the difficulties of the COVID and الحاجات الاحترازية اللي أجد معها. ولكن the evening segment is still the same as the previous 3 years. And to sweeten the deal for you also, we try to bring to you something really contemporary, which makes a big difference. So we are, the theme of the conference is something called ESP, Environment, Social Responsibility and Governance. This is the latest out there in the developed world, and they talk about investing using those 3 themes or these 3 spirals. And to make it even sweeter, we invited the best you can find out there in corporate governance. We invited 2 top-of-the-line scholars. One of them was with us last year, Dr. Edmans. He is the head of the corporate governance in London Business School and a professor of finance as well. He is the author of this book. I'm going to flash it on the camera here. Hopefully the camera will pick it up to the audience. It's called Grow the Pie, How Great Companies Deliver Both Purpose and Profit. And we promised Alex that we will acquire this book and give it to you for free here. We did order the copies. The copies did arrive in Saudi Arabia, but they went to Dammam through FedEx rather than Riyadh. And it took a while to clear them. They are on the way, but inshallah, we will send them to you. Then we also have another scholar, Dr. Alfred Osborne. He is a professor of economics and entrepreneurship. And he is also the chairman of the Bryce Entrepreneur and Innovation Center in Anderson School of Management at UCLA. Later on, they will be talking to us. And with that, let me go to the agenda, which what you will see in the coming 2.5 hours. And inshallah, there will be light hours, and they will move very excitedly, very fast. What we have here. Okay, keep going. All right. So this is the agenda. You have now a bag, and in the bag there are certain good things. First, there is the agenda, which you see up there. And very soon we will give the floor to Dr. Mashhour, where he will make a brief presentation on the rationale, the objectivity of the work we do to determine the corporate governance index and the lessons we have noticed in the last 3 years and how companies and the culture of corporate governance start to catch up. And indeed, it's showing in the performance of many companies. After that, then we'll move on to an exciting session where the two speakers will be with us. We'll start with Dr. Alex, who will speak for 25 minutes, then to Dr. Alfred, who will speak also for 25 minutes, then we'll open it for questions and answers from here, as well as from the Zoom colleagues out there. Then after that, we will distribute the award, the Excellence Awards. Our president is with us here to help us hand those awards to you. Inshallah, when your name comes up, you will come up here and get the award and have a picture for the memory. And after that, inshallah, there will be a social hour, and we ordered food from some of your best caterers in Riyadh, at least based on what we know. Before I go further, I would like also to recognize my colleagues who work so hard in the center, and sometimes we keep it at the end when we are in a hurry and we forget about them. We have Dr. Mashhour right here. You will see him very soon on the stage. He is the executive director of the Corporate Governance Center. We have Dr. Najati. He is the head of the research department there in the center. Then we have Miss Khulud Al-Harbi. Where are you, Ustadha Khulud? Khulud right there. And then also Al-Ustadha Ghada Al-Sheikh. Both also work as a team with us. And inshallah, sit back, enjoy, and inshallah, you will have a great time. Before I go, I would like to bring to your attention also a very important booklet right here. It's in your bag. This has the history of the development of the Corporate Governance Center in Alfaisal University. And the last pages from page 18 and on, it gives you a brief on the sequential annual conferences and the theme of each one of them. And with that, I call on Dr. Mashhour Mourad to the floor here, and he will start his presentation. For the presentation, please keep your questions and answers, and at the end there will be a session, as you see in the agenda, for that. With IT people.
لا أول واحد. كيف أدعو إلى فكرة؟ بالكيبورد أو بالماوس؟ مش قريب من الكاميرا. خلي قريب من الكاميرا عشان يطلع صح. Assalamu alaikum. I'm going to try to stay close to the camera for the Zoom audience to hear me, because there's this mic here. We have this other mic here for the audience that's in presence. I have quite a bit of slides to go through, but some I'll go through quicker than others. So this is the second International Corporate Governance Conference. We're at Alfaisal University, for those of you who are on Zoom, in Riyadh. So we're going to start with just a little bit of an overview of the Corporate Governance Center. It's in its 5th year. So it started in 2016. There was a generous grant given from the Saudi Arabian General Investment Authority to start the project. That authority is in charge of promoting investments in the country, inward investments, including foreign direct investments. And it was like a 3-year grant. In each year, there was a conference. This is the 5th in a series of conferences. So I've been with the center this is my 2nd year now, and this is our 2nd conference, and we have some very good information to provide you with. And you can see here pictures from the earlier conference. And here we have one of our professors that was Stephen Davis, who was a consultant from Harvard for us and helping develop our governance rating model, along with an existing company that's called Coburate that does credit ratings as well as governance ratings. What's unique about our rating is that we adapted to the regulators' mandatory regulations over here, as well as some other advisory regulations for listed companies. This really took on a large momentum once these governance principles were updated, and there was a really strong mandate to improve the governance, the transparency, the disclosures requirements across the country. And it was very helpful. I think it was driven by Saudi Arabia's Vision 2030 that was announced, and it called for really reforms across the board in many ways, and this is one of them. This is a picture you can see from our last year's conference, where we had 2 keynote speakers here, Professor Alex Edmans and Simon Osborne, who's an expert at board evaluations. So this is, I'm gonna again go a little quickly through this. We have an assessment department, research department, and a training and education component to what we do here at the center. Of course, the big real thing that we do uniquely that no other organization does in the kingdom is the development of an annual governance index, where all listed companies on Saudi Arabia's premier stock exchange, Tadawul, are rated by us from a governance perspective. And we will be announcing the results and showing some comparisons of where the index what direction it's been moving over the past couple of years. These are some of our other services that we do. We do provide individual assessment reports for companies who would like to know a little bit more about themselves and about our process. So we do offer that service, and it's available on our website, exactly what we do. And there's a whole list of other, things that we do as well. Okay, now we're going to talk about the index, and I think this is what a lot of the people who are in attendance over here are interested in knowing. And we will talk a little bit about our methodology and how useful it's been. Okay, we did give a little bit of a background already about how it started. One of the things that we capture, okay, we have a model, and it originally started with over 400 variables that we look at across a wide variety of different categories. We look at structures, policies, processes, and practices. And they're all grouped into 4 main key categories. These are the board of directors. So we have a lot of variables that deal with that. Shareholders' rights, that's another category. Public disclosure and transparency, yet another. And stakeholders' rights, finally, ending with that. And we'll go into more detail about that too. Okay, corporate governance involves a set of relationships between a company, its management, its board, its shareholders, and other stakeholders. Corporate governance also provides a structure through which the objectives of the company are set, and the means of attaining those objectives, and the way in which performance monitoring is determined. And this is really one of the benefits we're gonna see throughout this is in an era of KPIs and performance measurement, the CGI, or Corporate Governance Index, really helps capture that. And we're gonna show you in some later slides how that is. Okay, so some of these things, like I said, I'm gonna go through a little bit, quicker than others. I'm sure a lot of you already have a background about, what this is, and I want to tell you just a little bit more about what we do. Okay, now obviously corporate governance is important. It's been in the headlines, international headlines. It's been the driver for a lot of reform movements. And it's a means, by following good corporate governance practices, to try to minimize risk, minimize fraud, minimize just the severity of problems when they do happen. Problems are inevitably going to happen, but we don't want a whole disaster where the whole company just goes under, like what happened with WorldCom and Enron. So so that's why after a series of large scandals that were systemic, because a lot of people were affected by them. Reforms in corporate governance took really an added degree of importance. Okay, we're going to talk here now about our model. Okay, so in 2017, our model started with 117 variables. We assessed only the top 92 companies listed in Tadawul, and
we awarded a few companies based on our methodology. The standards in 2017 were a little different. The CMA had not yet updated their principles, adopting more of best practices from OECD and making sure that they blend in with where the Saudi market is at the time and with our particular local needs, cultures, and where we're at. But there was a big breakthrough once those principles were updated, and some of those were made voluntary, but some were mandatory. There was definitely a lot more disclosure requirements, and getting companies to accept this new culture of more disclosures and more governance processes, exposing, acknowledging conflicts of interests, minimizing them, and on and on. There's a whole list of things regarding not just disclosures, but also with board functions and board qualifications and committees, etc. And there was progress in year 2, continued progress in year 3. And while we did have 300 to 400 variables, again, every year we continued to update our model and make sure that variables that were not really helping much in terms of explanation. For example, there was compliance across the board on it or something like that, but we really didn't need it, at that point. And finally, where we're at right here is we have a model of 225 variables for all of the listed companies that are not in the financial sector. We have an added set of variables for the financial sector, which includes banking and insurance. And the reason is they have also, in addition to the Capital Market Authority, they have another primary regulator, which is the Saudi Central Bank, and they have their own additional requirements. Okay, so I'm gonna move a little bit, quickly, through some of these, self-explanatory slides, and I'd like to talk a little bit more about getting into the actual model. Now, Corporate Governance Index and Vision 2030. Okay, just okay, we believe that it's absolutely essential to develop a sound corporate governance index to monitor and promote good governance among Saudi corporations with the Vision 2030 objectives. We believe good governance is a key to success for companies in the increasingly global competitive market. Good governance also provides assurance for long-term profitability and sustainability. And we're going to be talking with the theme of this conference when we're talking about ESG. The word sustainability is going to be coming up a lot more. Sustainability and the purpose of corporations, and I know Professor Alex will probably elaborate a lot more on this. Good governance gives a positive signal to international investors. And in fact, when we talk about international investors, this was one of the key drivers of Vision 2030 to open up Saudi Arabia to foreign investors, as well as domestic, and to really be an integral part of the international community. And we have made some good strides in there. Saudi Arabia is now part of several major emerging market indices. This happened in 2019. And what comes with that is, a commitment to measure up to international standards. So where somebody who wants to invest in a local company, well, they're familiar with our accounting standards, our reporting, on companies, and just across the board. So we'll have the right amount of disclosures that they need to evaluate whether they want to, invest, or if they're currently investors, whether they want to continue to hold or to sell, exit their position. So these are really, very important. And so disclosure is key of all material, information. Okay. Again, I guess, every year we do talk a little bit about, how we've built the model. We expect that there's, new people coming, to look, but I'm just going to try to move a little bit more into the results, for this year. And when I do talk about the results, I'm going to talk about some of the key aspects of our model. So our governance model is evidence-based, okay? It's not based on a survey or that we send to executives and ask them to answer. It doesn't work that way. It's evidence-based. So when we have variables, we look at it and we want to make sure that we can answer it. So if we need to be able to find that information, whether it's in the company bylaws, whether it's on their website, whether it's in their regulatory filings on the Tadawul, the stock exchange website, the timing of those disclosures to the General Assembly, all of these things. But we also give companies a chance. If we don't find things, we do write to each company and ask them that we can find these information. And those companies that do respond, are rewarded, in the ratings that they've made more, disclosures. So we don't have to mark them 0. It's generally a 1-0 type of scoring, on these different points. Okay, now this is also something, and I think we can show it right here. It's a weighted score. When we're talking about a weighted mean score. So each of the 4 categories, public disclosure and transparency, board of directors, shareholders' rights, stakeholders' rights, they're scored on a 0 to 100 scale. But then to get the overall total score, we weight them. So for example, public disclosure and transparency is given a 30% weight. Board of directors, 35% weight. Shareholders' rights, 25% weight. And stakeholders' rights, 10% weight. Just like you'd see in any academic institution, you score above 90, you get an A. Above 80, you're going to get a B from 80 to 89, C and D and F, as you'd expect. And this shows the 225 variables that we did talk about, which is the current amount in our base model for all non-financial companies. This shows how many variables we have in each category. So in public disclosure and transparency, we have here 71 variables for our base model. Banking, remember, banking and insurance are financial and they have, additional variables. So in this category, banking will have 7 additional variables, insurance another 3. and so forth. This is how it is, how it's split. The key regulators are the Saudi Capital Market Authority and the Saudi Central Bank. Okay, so I'm gonna move a lot quicker right now because I think we're limited in time due to the late start. And this is just an example right here of one variable and how we score it. Now, this is a variable that deals with board of directors and their oversight over executive management. This is a question, so the board has reviewed and evaluated the performance of the executive management. We need to see that there's evidence that they actually did that, okay. The board has developed succession plans for the management of the company. Okay, we need to see if they did that, there's evidence, and then we score it accordingly. Sometimes scores are split, and so that's why you see the 0.5. There's an AB part or something like that. And we do score higher for the voluntary, you know, especially if there are regulatory requirements. We can split them and assign scores of less than 1, but we do award more for the above and beyond regulatory if they're going to comply with or adopt some additional voluntary governance best practices. So I'm going to move quickly here. Okay, now we're into the index. So this is what's new for this year. Our cumulative score for all of Tadawul was 79.86. We're just barely scratching right there on the B category, okay? And this is based on a score of 77.27 for public disclosure and transparency, board of directors 79.98, shareholders' rights 78.39, and stakeholders' rights 45.44. Here's a summary of some of the statistics. So here we have the overall score of 79.86, okay? And we have the same scores that I showed you in the previous graph, but we have additional information. So in addition to these mean scores, we have median scores, you know, for those of you interested in the, you know, power of statistics. And we also note the standard deviation. So once you have a larger standard deviation, coupled with the mean, it really, you know, weakens the relevance of that mean, or tells you maybe it's not all centered around the mean. So that statistics gets a little bit less power. Now we do have one category, shareholders' rights, where we had a very small standard deviation of 4 around the mean of 78, which tells you that this score of 78 is you know, very meaningful, and we can see that there's a lot of sensitivity towards shareholders. So we have the original mindset of you know, companies responding primarily to their shareholders. And here, look, we have maximum scores. So the highest score was given a 99.36. So we do have companies with very high, you know, governance ratings this year. And the minimum of 56, which also is not too bad as a floor for the overall score. Now this shows from 2019 to 2018. So there was a jump here. There was a jump of about almost 11%, 10.5% moving from last year to this year. So there's improvement almost in every category. When you look at here, even though we have a low base for stakeholders' rights, it's still a 21% improvement over last year, but there's a lot more work to be done here. And if we look over a 3-year period, we still see a continuous trend, improvement year on year. But last year, we've seen a bigger improvement than in previous years. Key observations. So, as I was saying, the corporate governance index improved by over 10.5% over the prior year. There was improvement in each category. Stakeholders' rights showed an improvement of 21%, but it's still at a low point. And as we're talking today about ESG, and we're talking about especially the S part in the ESG, in which we do capture, in our model, and that's why it's right here. Social, which deals with employees, customers, suppliers, society, and environment, community. As we move, and as the world is moving more from a shareholder-centric to a stakeholder-centric, that still not a deviation away from shareholders. It still incorporates them as a stakeholder, but giving sustainability and sensitivity to these other stakeholders their due share in attention. And our keynote speakers will be speaking a lot about this, and so just want to identify that. Nonetheless, we have improved, but this type of conference and this investor-led movement of focusing on ESG is going to be helping to drive that goal. Now here, again, I'm going to go a little quick, but in addition to just one statistic, a graph, like a histogram, is going to show you some distributions. Now,
can we skip into the conclusion because the speaker's waiting?
Okay, all right. Okay, so these are just pretty much some additional information. I think I covered most everything. But one other thing I did want to mention, like in terms of measurement, okay? What the CGI, what the index allows companies and regulators and people to see is a way to measure that there has been progress in governance. We've seen this one typical company. In 2017, they had a score of 65, moved to 7.3, and now they're going to be an award winner at 97. This progress, this attention by a listed company to governance and giving it really that type of focus would not be captured if it wasn't for the index. Who would know? So it's important when we're measuring and we're letting the world know, and we're going to see ESG investing. The G people, large institutional investors are willing to pay a premium for those companies that have better governance within any sector. That's an important criteria for them. This also shows that same company and its improvement compared to its sector. So when it was at 65, it was actually underperforming its sector in governance, okay? And then it exceeded the sector as it was instituting, better practices. And finally now it's way above its sector. Sector improved, they improved more. Again, these are things that we capture. The whole food and beverages industry, we can see that the whole sector has been moving upwards. Again, this is something, one of the beauties of the CGI, the index. And hopefully we intend to expand our practice to cover GCC companies, not just Saudi Arabia. tadawul, and family businesses as well. Thank you very much.
Alex is waiting.
Okay. How do we transfer to his video? Okay, I can put his slides.
They can help you.
Okay. Hey, Dr. Alex, who have the slides?
The number for Alfred, we have to notify him 25 minutes to be ready.
Okay. هنا كمان بس هو عنده maybe he has to control it. طب كيف تحطه؟ نقدر نتكلم معه ولا؟
Sorry guys for the question and answer. Unfortunately, took time here, but maybe we will have time to go then for questions and answers.
Alex, can you hear me?
I can, Mashhour. Thank you very much for the invitation. Unfortunately, I can't start my video. It says you cannot start your video because the host has stopped it. So whoever's the host needs to enable me to share my video.
Okay, we'll have our IT people try to work on that right now. At least we do see our slides, so that's good. Oh, I think we got your video up here now.
Absolutely. Shall I get going?
Well, let me introduce, I think Professor Bajis, our dean, made an introduction, but actually if I did your full introduction, it would take probably a full half hour because you're such an accomplished person. But let me just go a little bit briefly. Professor Alex studied at the MIT Sloan School, and that's where he got his PhD. He did his undergraduate at Oxford. He did a stint in investment banking with Morgan Stanley before moving into academia. So he does have it. He's very, very well published. So not only the books, but in journals. He's published in the American Economic Review, Journal of Finance, Journal of Financial Economics, Review of Financial Studies, the Journal of Economic Literature. He's the managing editor of the Review of Finance, associate editor of the Journal of Financial Economics, a research fellow for the Center of Economic Policy Research. I think it's important that they know, your research credentials, because when you talk about your findings, it's based on rigorous academic research. This is not just somebody saying, oh, well, we think, that this is the right, course or the right answer. It's based on rigorous fact. He is a faculty research fellow for the National Bureau of Economic Research. He won the Moskowitz Prize for Social Responsible Investing, the FIR Prize for Finance and Sustainability, the Investor Responsibility Research Center Prize. Just the list goes on. I can't, continue. His research has been covered by, the Wall Street Journal, Financial Times, the New York Times, The Economist, the Times, Bloomberg, BBC, CNBC, CNN, even ESPN, okay, has covered his research. You'll see him on YouTube. He has TEDx talks and TED Talks. So anyway, I just wanted to, again, the list just goes on. I would be talking, for a very long time. So let me go ahead and ask Professor Alex to give us his lecture.
Well, thanks so much, Mashhour. It's great to be here. It's great to partner with the Corporate Governance Centre again. So I was very kindly hosted by the Centre 2 Decembers ago. I was in the audience when the Corporate Governance Index of that year was announced. And it was just so encouraging to see this index being produced, and one which is based on research, which is something that Professor Murad was highlighting in his introductory remarks. So what I want to do is to talk to you about corporate governance, what is it and does it matter? And you might think, well, why am I choosing to speak about this? Because don't we all know what corporate governance is? That's why everybody's here. And does it matter? Well, obviously it does matter. That's why we're attending this event. But what I'd like to do is based on research, actually suggest a slightly different perspective on corporate governance to what people typically think about. And in terms of does it matter? Well, certain dimensions of corporate governance do matter, but other dimensions do not. And so this is why it's important to have an evidence-based approach, which is indeed the approach that the index is taking. I saw there was an earlier question about, well, making materials available. I will be very happy to send my slides to the Centre for distribution afterwards, so there's no need to take notes. But let me start by explaining, well, what is corporate governance? And let me give you an example of what people thought was a sign of really bad corporate governance. It was a couple of years ago in the US. Bob Iger, the CEO of Disney, was said to be paid an obscene amount of money. People said he was being paid $66 million, which is 1,424 times as much as his employees. And so people accept that CEOs are talented, but 1,400 times, that just seems to be insane or absurd. And why would we care about this in terms of governance? Well, for two reasons. First, directly, this costs a lot of money, which otherwise could be spent on investment or worker wages. And the second is indirectly, if there's such high inequality within an organization, that could demotivate employees, maybe customers would boycott you for all of those reasons. However, right, we do need to look at evidence, and there's almost two sides to every story. What was interesting here was actually Disney had performed really well. So in just the 1 month prior to the announcement of his pay, Disney's market value had gone up by $75 billion. And you might think, well, corporate governance is about the long term, as Professor Murad was highlighting. But even if we looked at a long term, if we looked at what had happened since his appointment in 2015, actually, the company had done really well. Its total shareholder return was 578%, whereas for the S&P 500, it was only 140%. Now, we don't just care about shareholders. As Professor Murad highlighted, right, we do care about stakeholders very seriously. But in fact, the profits to Disney were not at the expense of stakeholders. In fact, the company had created a lot of value for them. So it had created 70,000 jobs since Bob Iger became CEO, and customers benefited. So they benefited from great products and services like Avengers Endgame. So it wasn't because they were extorting from customers. Okay, so this is really important because we often think about bad governance being splitting the pie differently. Too much for the CEO means less for investors and less for stakeholders. So we often think about it as being a fixed pie. We want to avoid things like this where the executive gets too much. So if so, well, what does good governance? It's splitting the pie differently, making sure that the orange goes up. But in fact, that's not what I think is the most important facet of governance. It's not splitting the pie differently. It's instead caring about the size of the pie. So let me give you a different example. So let's take our minds back 40 years ago, and let's say that you're the CEO of Kodak. Now, 40 years ago in 1981, Sony, your biggest rival, launched the Sony Mavica, which was the first ever digital camera. So how do you respond if you are Kodak? Well, Kodak had every opportunity to respond. They actually held a patent for the digital camera. Do you want to see what their digital camera looked like? It looked like this. So it's not as sleek as the digital cameras that we see today, but they did have a patent for it and they had every opportunity to respond. But they didn't. Why? Because they had two short-term horizons. So their own head of market intelligence predicted that digital cameras would replace film, but it would take 10 years and that was too long for the CEO to care about. Why? Because they were being paid according to short-term earnings. So we know what happened in the end, right? Kodak went bankrupt. That was a disaster for society. right? At its peak, it had been worth $31 billion that got wiped out, and 145,000 employees lost their jobs. But what is really striking here is that this was rarely thought of as being poor corporate governance, right? The CEO or the executives of Kodak are never given the same anger that Bob Iger of Disney received. They never saw them as being badly governed. Why? Because it wasn't the case that executives and investors benefited at the expense of everybody else. Everybody lost because Kodak underperformed. But actually, the fact that executives and investors lost out is of no consolation to the 145,000 people who lost their jobs. So what I'd like to see bad governance as is shrinking the pie where everybody loses out rather than splitting the pie differently. Okay, so what good corporate governance involves is not just splitting the pie fairly, even though that is important, but growing the pie, ensuring that companies remain innovative and productive. And so this is one of the key aspects of making sure companies are well governed. So as to highlight this, right, we first want to create value for both investors and stakeholders. Then we need to ensure that the gains are fairly distributed, but the primary responsibility of investors and boards is to make sure that companies create long-term value. Okay, so the second part of my talk is, well, does this actually matter? Well, I've defined corporate governance as growing the pie, but, well, there's loads of other ways to create value, right? Good marketing, good production. How important really is corporate governance? And the important thing here is to be extremely rigorous about the evidence, which is something that Professor Murad was highlighting, and I really appreciate. Why? Because of this danger of confirmation bias. So what do I mean by confirmation bias? This is the idea that people have their pre-existing views of the world, and they will be very quick to accept evidence that supports their view, but also they'll dismiss evidence that opposes their view. And because many people do believe that corporate governance matters, they might be willing to accept any piece of evidence that shows that it's relevant, and even if that evidence is not that rigorous. And so this was the topic of my TED talk that Professor Murad mentioned, what to trust in a post-truth world, about being really stringent with the evidence. So what I want to do for the next 10 minutes or so is to go through what I see to be the most rigorous evidence on some surprising results that might actually be inconsistent with what we previously thought. Before I get to that, let me go to one example of the importance of rigor. So I'm taking Forbes, which is obviously a very respected outlet. And what they wanted to highlight was the importance of stakeholder orientation. So they refer to a study which found that companies that excel in sustainability and responsibility outperform their peers financially. Okay, there's nothing wrong at all with that. But here's the concern. The next slide. That is the premise of a new report, and it is an accurate one, judging by many conversations with those interested in better business, better governance, and a sustainable future. So how did the journalists judge whether the report was accurate? Not by looking at whether it was published in the world's top journals, not by looking at the methodological rigor or the scientific accuracy. She just asked people who believe in governance, do you think, well, governance matters? Do you think this report is right? And obviously they would say yes. Okay, so what I want to do is to look at the most stringent evidence to avoid this problem. And so let me start with perhaps the most famous paper written on corporate governance by finance academics, which looks at various things that companies can put into place in order to insulate themselves from shareholder oversight. Okay, so one of these things is a staggered board. So this is a way in which you can make sure that the board is difficult to kick out. The board is something where you're only elected once every 3 years. There's a golden parachute, right? The golden parachute is a way of making it difficult to kick out the manager without paying them a lot of money. and there's a poison pill which prevents them from being taken over. In fact, there's 24 different devices that companies can put in order to insulate themselves from shareholders. Now, you might think this insulation is really bad. It means you're not accountable. But there is a flip side, right? So that flip side is actually maybe these ways of protecting management are good, right? Because if management does not need to worry about shareholders, then management can think for the long term rather than having to manage for the short term. So what is true? Are these devices good or bad? Well, what we do as academics is we say, let's look at the evidence. And so this paper was published by professors at Harvard, Stanford, and Wharton. And what they found was that well-governed companies, so companies without these protection mechanisms, they beat poorly governed firms by 8.5% per year over a 9-year period. And so this is one of the big papers which really made ESG investing mainstream among investors. Corporate governance matters, and so this is why the index that Professor Murad showed is something to be taken seriously. But there are some twists, though. And so this next slide shows the twist. Corporate governance doesn't matter in every single situation. So what this paper by Giroux and Muller looked at, they're from NYU Stern, another top university, is they said, well, maybe corporate governance does not matter if you're in a competitive industry. Why? Because if there's a lot of industry competition, the CEO will have to work hard, even if there's bad governance. So what they're saying is it's only in the non-competitive industries, let's say utilities, that we need to care about governance, because that's when the CEO has a tendency to slack off. And so this is very important because it means that we don't want to take a box-ticking approach to corporate governance. Yes, we would love to find a company which has great financials and a great management team and great competitive positioning and great governance. Sometimes we can't find a company that ticks all 4 boxes. And actually, some cases, governance may not matter so much if there are other things such as industry competition to ensure that the company is maximizing value. Okay, there's another paper here, but it's just in the interest of time because we started a bit late. Let me skip that. Now what I want to get to is executive pay. Why? Because that's what I opened the talk with. And so many people, when they think about executive pay and how is this good or bad governance, they look at the level of pay. So too high pay relative to everybody else is seen to be a bad thing. Indeed, in a couple of US cities, they tax you if your pay ratio exceeds a certain amount. And this is based on some evidence. So a few years ago, I was testifying in the UK Parliament, and the witness before me said there was a study finding that firm productivity is negatively correlated with the pay ratio between top workers and bottom workers. So the idea is the greater the inequality within a company, the worse the performance. Why? Because people are demoralized. However, we need to be really careful because, as I said in the start, evidence can sometimes be flimsy. And actually what this witness quoted was a half-finished paper. Right? In order to get papers published in the top journals, they need to be peer-reviewed to check their methodology. And in fact, the published paper, when it came out, found completely the opposite result. So when they went through peer review and had to correct their mistakes, they found the opposite. Actually, high pay ratios are correlated with better performance, not worse performance. And why? Well, the reason is because of the Disney reason I mentioned at the start. If a company performs really well and generates high long-term returns for both shareholders and stakeholders, then if pay is linked to performance, then pay should be high. And this is what's borne out in the data. So if the pay ratio is not the relevant thing, what is the relevant dimension of pay? Well, it is the horizon of pay, whether it's long-term or short-term. And this is great because this is what's supportive of what's in the index. So again, in the interest of time, let me skip some of it. Let me not talk about my own paper. Let me talk about somebody else's paper. So let me talk about the second paper here. So what this paper looked at is what happens when shareholders vote for a proposal for a company to pay executives according to the long term. Now, one of the dangers here is it correlation or is it causation, right? Because if shareholders vote for a long-term pay proposal and performance goes up, you might think, how do we know it's the proposal that's causing the better performance? It might just be the investor being there and the investor being really engaged, which causes the performance because the investor is monitoring. So what they do is something called a regression discontinuity. So this involves taking some proposals for long-term pay that pass with 51% of the vote and those that fail with 49% of the vote. So the idea is whether you succeed or fail, whether you're 51 or 49, that's random, right? Because if it was a large engaged investor that came in, they would increase the voting support to say 70%, not 51. And so what they found was that when these long-term pay proposals come in, profitability goes up, innovation goes up, and also various measures of social performance go up for the environment, customers, and society, and in particular employees. So what this highlights is the best way to make sure that the company serves wider society is not to cut the CEO's pay and give it to everybody else. It's instead to pay the CEO according to the long term, because if the CEO knows that he will be paid according to the stock price in 5 or 7 years' time, then he will have to do things such as invest in his or her employees, invest in innovation, and treat stakeholders well. And that's going to go into just some of the final topics here on the S and E of ESG. So this is one of my own papers on the importance of treating stakeholders well. Now, we typically think that if a company treats stakeholders well, it's at the expense of investors. But in fact, the evidence suggests it's not the case, which is why in what Professor Murad said, there's a lot of stakeholder concerns in the governance index. So what my paper looked at was companies that treat their employees well as measured by their inclusion in the 100 best companies to work for in America. Now, we typically think if the pie is fixed, anything you give to workers is at the expense of shareholders. But I showed it's the opposite. Like when you invest in your workers, it grows the pie and shareholders benefit because workers become more productive and more motivated. So these companies outperform their peers in stock returns by 2.3 to 3.8% per year over a 28-year period. And obviously I need to do tests to suggest it's employee satisfaction that causes better performance rather than better performance causing employee satisfaction. But because I want to get to Professor Osborne, let me just not go through this here. Just take my word for it that I control for that. So instead, let me go through the final study, which is again an important nuanced one, which is about the importance of materiality. So what do I mean by materiality? Now, as Professor Murad was saying, stakeholder capitalism is the buzzword of the day. We need to serve wider society, customers, the environment, employees, and so on. However, we can't serve everybody because then we would be all things to all people, we'd be scattered and unfocused. So what good corporate governance involves is knowing what are the stakeholder issues that are most material and focusing on them and perhaps deprioritizing others. So what this looks at is the materiality map, which the Sustainability Accounting Standards Board introduced. This goes industry by industry to highlight who are the most important stakeholders. So if you're in the first column, extractives and minerals processing, clearly the environment matters because you have a big impact on it. But if you're a bank, well, your direct effect is not that high. So maybe what matters more is selling practices and product labeling. We don't want to be in a Wells Fargo fake bank account scandal. And so what the study looked at was it took data from MSCI, which is perhaps the best known ESG data source, and it looked at companies that did well across the board. They did well in every ESG dimension. And they found that those companies did not actually beat the market. They only beat the market by 1.5% per year, which is insignificant. Now, when they redid this with a materiality lens, looking at companies that did well on the material issues, but scaled back on the immaterial ones, then they did beat the market by 4.8%. So this is striking because it suggests that it's better for companies to do well on only a few things than to do well on everything. Because if you're doing well on everything, then you might be forgetting about your shareholders. So a truly purposeful company is not one that is all things to all people, but one that focuses on the issues that are most material to them. Okay, so just to wrap up, I just released a book about this last year called Grow the Pie, How Great Companies Deliver Both Purpose and Profit. And so why I did this is because it's on the topic of corporate governance and responsible business, but it wants to be based on evidence because there's a lot of myth floating around. Now, unfortunately, a lot of this academic evidence is written in academic language just to be stuck in academic journals. So I wanted to bring it to life with some real life examples and frameworks and write it for practitioners. And kindly, the centre has obtained copies of this book for all of the people in physical attendance today, but because it's still stuck at customs, it will be distributed to you after the event. But hopefully this will be a relevant guide to people wanting to practice good governance. And on the website here, I put for free a lot of developments that have happened in corporate governance after I finished it. So thank you so much again for the attention. Thank you to Professor Murad and the Centre for inviting me. Let me hand that back to him and to hear from Professor Osborne.
Okay, thank you very much, Alex. Wonderful lecture. Really appreciated it. And we'll come back to you during the Q&A session. So let's see if we can get Professor Osborne.
Can you tell him to send a question through the chat?
Oh, any questions, please send them through the chat, and then Professor Najati will look through them and then bring them to our attention. Okay, we see Professor Osborne, his computer is working, beautiful UCLA background behind him. Can you hear me, Al?
I can.
Okay, wonderful.
So
let me introduce you to the audience. I know Professor Bajis made an introduction, but let me just give some additional background. Professor Osborne is the Senior Associate Dean for External Affairs at the UCLA Anderson School of Management. He's also a Professor of Global Economics, Management, and Entrepreneurship. He's the founder and faculty director at the Harold and Pauline Price Center for Entrepreneurship and Innovation. I'm going to also say, Al started his academic career at Stanford, where he got his undergraduate degree in electrical engineering. He has 2 master's degrees from Stanford, one in economics, one in MBA, and he's got a PhD in business economics also from Stanford. His academic career has been always at UCLA, where he joined as an assistant professor and has been there since. He's actually an experienced board director himself. He's sat on the boards of several Fortune 500 companies, including Times Mirror, Nordstrom, many other not-for-profit boards as well. He's led many initiatives. His research gets into private equity, venture capital, values. All that is very important. He has a broad sense of research, diversity, and the value of cognitive diversity, the acceptance of different viewpoints. So diversity is not just demographic, but it's also a diversity of minds and ideas. Again, I can go on and on and on for long accolades of his, illustrious career, and we're, very honored and pleased to have Professor Osborne speak with us today.
thank you, Mashhour. It's a pleasure to be able to be in this setting, and I'm glad I had an opportunity to hear some of what Professor Edmans had to say here. I very much appreciate his perspectives. I remember that literature, I'd like to, let's see here, begin the process of sharing my screen.
It's early morning in Los Angeles, so you can see the daylight behind him. It's evening time here.
Yep, so we'll just do that up here. Let's see.
Good, that worked.
Did you get it?
Yes.
And now here's the, okay, I assume everybody can see the first page. This is titled the Corporations and the ESG Imperative. And so assuming then that we all have eyes, I'm going to begin my presentation. The agenda I've chosen to talk about today is really deal with these two purposes here. I thought it was a good idea to revisit the purpose of the corporation. What is it that a corporation really is supposed to do? And in that space, it's good to remind ourselves about the value imperative and the current concern, which has raged for a long time, frankly, that pits quote unquote shareholders versus stockholders, broadly expanded now, and I don't have it written here, to include stakeholders. We want to come back to that, and a couple of things I'm trying to highlight here. And then the question about what directors do, keeping in mind for the public corporation today in the world, its fiduciary duties really matter. And as a sitting director in companies that have to deal with issues like the carbon footprint, and environment and sustainability issues, they matter increasingly a lot to our shareholders. Which then takes me into the second part of my chat, which is talking directly about the ESG imperative. I assume a lot of those in the conference will have a good idea as to what ESG is, but I have chosen to put a little image on the right, which really tries to handle what the intersection is that people are talking about, both of the environment, social matters, and governance. And when you cut to the chase on that issue, ESG is really something that good corporations have worried about for a long time, but you could say that the environment part of the E deals with the planet, and therefore we got such things like the UN development standards and things that we're trying to get to. Social, the blue part of here in this picture, deals with people. And we're finding that there's some major issues here that, particularly here in the United States, that have been exposed as a result of things like the Black Lives Matter movement, things like the defense and related issues of how systemic racism affects the kind of inputs and outputs we see and how they are distributed. And then finally, the notion of governance, which speaks to profit. So the three Ps are still essentially what the ESG is all about. The planet, its people, and given how we've organized to produce goods and services in our society and improve the social welfare, profits. And let me say for a moment that profits matter. I'll get back to that in a second, but I've always added a P when I think about these three Ps, and the P I add is philanthropy. In the United States, philanthropy is an important leg to solving a lot of the issues, particularly the intersection of these issues. And I call it the fourth P. Philanthropy can only occur if there are profits. There is no philanthropy unless there's profit in a free or primarily market economy or the mixed economy live here. And I've come to appreciate that. Mashhour talked about the boards that I've been involved with over my business career, but I'm currently chairman of Fidelity Charitable, which is the largest charity in America, and it is associated with Fidelity Investments. And from that position, I have been able to see with what we do, the importance of philanthropy to making the intersection of SEG something that's alive and viable. The firms can grow the pie, but it doesn't happen fast enough. Just simply, if you're an economist, you remember things like Edgewood's Bowley diagram, and and sort of when you kind of get to the core, you really do need growth, and that was a comment that Professor Edmans made that I think is absolutely essential. Growth really matters, and so ways in which that can be enhanced will solve these issues and make them converge. But there's a big force working now, and it has to do with investors and the investor stewardship prerogative I'm going to talk a little bit about under the auspices of what I'm going to call responsible investing nowadays. In the Anderson School, our MBA students are totally fired up, and this generation is totally fired up about these kinds of returns. I'm going to just mention a little bit about the Business Roundtable notion and corporate purpose. I think it's instructive that the largest fund manager be someone we pay attention to. That's BlackRock's Larry Fink, an Anderson MBA, who I think is getting it right. Looking at his recently released KPIs and his standard letter and some of the financial implications. But I don't want to forget a discipline that exists in the investment community, such as activists. And to the extent that we can get the timing right, activists play an important role in disciplining managers that may not be value maximizing as we would think. And then hopefully, I know we have limited time, so I will move this thing a little quickly here, should there be questions and answers that you might want to entertain. So let's just think about what is the purpose of the corporation? We've pondered this a second. Well, my view here is the corporation exists, as I indicated, to produce the goods and services that are in demand in our society. They assemble the supply factors, and if they do this right, they have margins and profits. And who gets profits? Well, those who risk capital in whatever form are absolutely essential to this game. And they must earn a return. And if there is no return to capital that's deployed in a particular activity, there is limited philanthropy. And unless the government intercedes, a lot of the things that fall into the S category or the E category don't get done. So, but the purpose then of the corporation, I believe then, is to make money. So then what is the purposes of directors when you're talking about making profits? Well, a model of this is not exactly the a thing that needs to be elaborated, but allow me to provide you with a description of what it is I believe a director must do. And since this is a governance seminar, we need to define what the role of it. I think that directors are trusted primarily to oversee the operations of any for-profit private corporation, to be sure that its goals are consistent and aligned with certain objectives and policies that promote value maximization, doing so by being fiscally responsible, keeping management accountable, and making sure that we carry out the mission. Now, as far as academic papers go, I think another important paper beside the Gumpers paper that Professor Edmans mentioned is going way back, almost 20 years, to the value maximization stakeholder and the corporate objective front paper of Michael Jensen that I thought was a particularly powerful piece some 20 years ago. Jensen tried to rationalize the issue, the debate that has been going on for some time of the purpose of the cooperation. Is it to satisfy stakeholders or some group of actors in the production process, or is it to satisfy shareholders by maximizing the value of enterprise? And in his piece, he had an opportunity to talk about stakeholders and some other approaches. And he concludes by letting us remember that in the end, if you're talking about a scorecard for managers, the best scorecard is whether or not they are producing value at the highest level possible and are singularly focused on that to the neglect of other issues. Now, that has always impressed me because at the same time, if you're maximizing profit, you really can't do that if you ignore the interests of your stakeholders. And all great companies have value statements that talk about in wonderful language about this interest of trying to rationalize value maximization for shareholders in terms of investment returns, and a workplace or culture that values people, suppliers, customers, and talks about them in very elegant language. I've always liked the Johnson & Johnson credo, which to me speaks about these issues. And when this organization was started by the Johnson family, and General Johnson, I believe, is credited with putting out something that J&J calls its credo. And it goes something like this. If we take care of the nurses and doctors that are taking care of our patients, and we take care of our employees who are producing the goods and services that our doctors and patients need, that our doctors and nurses need to take care of our patients, our shareholders will earn a fair return. So what we have here is a reminder that it's an alignment of interests all up and down the line that makes it possible for people who believe in value maximization as the principal purpose of the enterprise, in all of its form, thinking of the capital stack, whether it's equity, debt, or other kinds of securities and other products, is an important alignment. So the focus has to be is, are we aligned with our purpose, is to make and produce the largest possible value for whatever it is we have elected to do. They may talk about that perhaps in discussion, because value maximization to me, I think, is particularly important. But for that to happen, a board has to be effective. So the effective board must be able to provide what I'm going to call informed advice to the management, honest oversight, and it must assure the future. And if we were to sort of drop down and break it all down to two things, boards have two important responsibilities that are embedded in that description I gave you. One is to be sure you've got the right CEOs and you promote and take care of him or her for what it is that they have to do. And that's where the incentive function of compensation and executive compensation comes into play, and issues of succession, of choosing the right person to be head of the ship. And then the second thing is the strategy, that is assuring the future. As you provide monitoring and advice, are you also paying attention to how the purpose of the enterprise is being actualized to generate returns? And assuring the future means some involvement in strategy. But the board is not expected to manage the enterprise. That's why you hire management. But you're supposed to be able to make the right kind of involvement. And I like to think about that, making sure that directors are independent, that they are careful in their duties, loyal, they're attentive, they're curious, they're skeptical, they're working in a deliberative body, they're collaborative and decisive. And when they come to decisions, as they must as a group, everybody obeys. That is why I believe the best boards behave according to something that we call NIFO. That is to say, they keep their noses in what's to be done, but they keep their fingers out. This is not an accounting term. Some people confuse it with the next in, first out inventory issues in the accounting profession. Noses in, fingers out. And to me, that's the real test of a board. Being able to manage that with a group of people who are your peers and make sure that the corporation does what it must and stays out of trouble in that process. That's the difference. That's being careful and loyal. That's very important. And if you do that, you'll be blessed with the business judgment rule. To me, this is an important foundation for what the boards have to do when they start thinking about spending corporate resources to satisfy ESG type of concerns. And there's a litany of them that the board may have to be considered. I mean, just think of trying to satisfy all the sustainable development goals that the UN put forth. How you engage in all of that at the board level. And a lot of it is what can you measure from the accounting sense. Now there's efforts to move along those lines, and I'll get to that shortly, but the business judgment rule is particularly important. So now that I've kind of shared with you my reminder, there are folks that I don't care about that. And nowadays, boardrooms are populated. This graphic tries to give you a sense. We have somebody on a soapbox from ISS trying to tell this particular board how to vote. So if we think of your companies or here in the United States, is this the future for your board? Do you want to be told by some group, whether or not it's academics or consultants who can say how you should vote or not? I am not so keen that that's the way we want to go. The purposes whose voice really needs to be sure is those who provided the capital for the enterprise to do the purpose for which it was intended. So investors sometimes use these folks as proxies to be basis. And I, in my career as a director, particularly in most recent years, I've had an opportunity to talk to many of these consultants because they are rating companies, and some of these ratings are sticky. As you can saw, some of the indexes and others try to say that folks who do these things do better, and most of that research is flawed in one way or another, just from the various challenges we face when trying to be scientific about some things that are very difficult to get good measures on. But that's okay. I think we need to improve the science to be better, but we got to be careful that it is our decisions in the boardroom that matters, and that this may well be an input to what we do, but it shouldn't drive notions. For example, let me take something that is particularly important to many third-party observers, that boards, the staggered board is a bad idea. That is the notion of directors being elected every 3 years as opposed to every year. To me, that's the same kind of short-termism that those that would believe in long-termism talk about. I happen to think that a staggered board can actually protect shareholders' interests better. Now, I say that the evidence is mixed, but it seems to me that that's something that ought to be, and we shouldn't willy-nilly react that boards should be elected every year. There should be a turnover based upon what people like ISS or Glass Lewis or any of the number of advisors say. That's something we can talk about. Now, I'm mindful a little bit of our time here, but I was given roughly 30 minutes. I think I have 6 or 7 more minutes to go forward. But to me, it was important that as directors and interested in governance, we remember the foundation principles. But the question now, is it possible for corporations to be successful, make a profit, but still do good in the world? I think the answer is yes. Now, good I put in quotes because it depends on what it is we think good is. And that now becomes a value judgment, and it's very subjective. And as an economist, I think we ought to be careful in whether or not we impose our value judgments on others. And sort of, this is the issue that we often face. Let the shareholders have their returns and they can decide how they want to spend it. This is if there is an issue here to think about. But I often kid about my students who are interested here in impact investing, for example, and ESG. They believe they can make a profit and still do good. A lot of money was made, let's just say, doing less good in the years of me as a baby boomer. And so now the millennials and the generation Y and Z and whatever have the charge now to clean up what we did, particularly when it comes to the environment. And that seems to be a driving force, and that's okay. So I think you can, quote unquote, do good as it is defined from time to time, because there is a long cycle on how things are called or not called. And of course, we know what these things are in terms of the ESG factors that are important. When we come to E, the big one today is climate change. I'll say a little bit about that. Greenhouse gas emissions. And of course, the question of water. For years, I was a director of the largest water company in the world, and we sold it to another company. But we could see the scarcity of water and the need how water had to be manufactured, quote, pure water as opposed to regular water because of the impurities that exist. But there's no more water in the world than there was from the beginning of time. It's just a question of what form it's in. And the question is, how can we improve some of these things, the sort of waste and pollution? Social issues are hitting us right in the face today. A whole question of working conditions, child labor. Indigenous communities have been neglected and exploited, both in America and all other parts of the world. And the European record here is not good historically, but it needs to be redressed now. How do we deal with all of that? Repatriations, better working conditions. How do we deal with a serious attack and a serious effort to redress the social injustices like we're trying to deal with in the environment? And then, of course, governance. And this is where a lot of the focus has been. So the issues there have always been things like executive pay, conflict of interest, Foreign Corrupt Practices Act, to give you an example, who goes to jail. And now increasingly, it is believed that broader diversity and the way in which the board organizes to do its works, being, say, perhaps more inclusive and more equitable in terms of the distribution of the residual value of the enterprise to the so-called stakeholders as opposed to others, may be one way of beginning to approach that. And you can't forget stack strategy, because governments has an important role to play in all of these factors. So these then are what we have to keep in mind. And I'm just going to jump over this because it's ESG impacts directly, and the focus has been with such things as SAAB and some of the new consultants that are trying to develop standards of how one should report and what they're doing. The focus is on the chief financial officer of the enterprise and the finance function, because that is where auditors and so on have a role to play, and investors in trying to understand the scorecard, which is, of course, the income statement and the cash flow and balance sheets, how all of that is all about. So there are three kinds of risks that are important here that are indirectly affecting performance. We have to worry about the operations risk that speaks to some of the carbon and so on. And then the supply chain risk, that is who is being fairly treated in the plots, like labor, for example. Then the product risk are what we're offering, the products that we might offer are safe. And so some issues, so safety, the product risk, the supply chain risks are the key risks, and I don't have time to get into all of them. Neither do I have time to get into what I think is the key core here. And I put forth the principles. The PRI is one group that has come up with principles of responsible investing. And as you will see, and perhaps are familiar with, it incorporates ESG issues in the investment analysis. So there's an effort here that if I'm going to invest as a fiduciary now, I'm going to invest the resources that have been granted to me in company A or company B. Are these good companies? And we're seeing that there is increased interest in that. And so there are other principles speak to what makes for things like transparency and disclosure, and adding as investors, raising the level and changing the culture in such a way that people bet on the right things and they are inclusive in how they do these things. And as I indicated earlier on, transparent. I think the biggest player in the world here is the largest fund manager, and that's headed by Larry Fink. And BlackRock has some KPIs that matter. The right-hand side of this slide, something I took from their website, you'll see the 5 things they worry about. They worry about board quality, the environmental risks and opportunities, corporate strategy and the allocation of capital, issues of compensation, making sure you believe in long-termism is what they call, and issues of managing the human resource. I think that as I try to extract and as I've listened to Larry Fink from time to time, the issues of quality speak to some of the concerns we can go in a little bit more. How the board is organized, is there independence, independence thinking, do they evaluate themselves and management and so on in a responsible way, and do they have the time to do it, and so on. So that's important, and as a lead director, I am well aware of those duties. The environmental risk and opportunity really speaks to, I think, the whole question here of can we get to a world, for example, in the industry I'm engaged, one of the industries I'm engaged in, with sort of the issue of carbon, greenhouse gases, are all these part of our corporate strategy? Do we take into account the externalities that these things produce? And we figured out ways to internalize them, but I think we're making progress. So the whole notion then is how you allocate capital to working with all of the factors that are necessary to produce value over the long term. And the way you might want to do that is to be sure that you compensate to promote long-termism. The key considerations then I want to point out here is the conversation by investors like BlackRock and State Street and Vanguard and even the public pension funds is summarized at the bottom of this slide. The board and workforce diversity consistent with local market-based best practice is a key concern when these investors talk to companies. They want to understand if we as directors understand the key stakeholders and their interests, and they want to be sure that there are plans to align with the global goal of net zero greenhouse gases emissions by 2050. Mashhour, I think I'm up against the time.
Right, yeah.
But this is the danger you have with professors who don't want to give up any other slides. So I will just quickly go to make I'd say the discipline that can help all of this is thinking about what activists can do in the capital reallocation as they worry about issues of governance and operational change. And there are good activists, and there are those activists that are just interested in short-term profits, and we have to be careful with how those alignments work. And so I want to conclude by saying ESG is here to stay. The priorities will change, but it will be the investment community, I think, the so-called impact investing that will affect the fortunes and the alignments of all the factors in the supply chain, from customers to suppliers, and keep the board then disciplined in what it needs to do. Thank you for your attention, and I'll turn it back over to Mashhour.
I had a question. It might be a little bit different topic, but it's to Professor Osborne on given your relationship with Johnson & Johnson, do you have any idea when their vaccine is going to come out for COVID?
The vaccine?
Yeah. We hear it's supposed to be.
I am not privy to that information, but I'll be glad to speculate with you. I'm hopeful that by the end of the month, we'll see them in distribution.
Okay. Okay. Professor Alex, maybe this is a good time. You skipped one of your research that you were going to talk about. Perhaps you could share with us a little bit more about that. I think
absolutely, I'd be delighted to do that. And before I do that, I just say there was a real huge amount of what Professor Osborne said that really resonated with me. It was a real pleasure for me to listen to him. And what's interesting is that we come from slightly different perspectives. We're in different departments, management versus finance, and we didn't coordinate, but there was a lot of overlap. And why I say that is because the paper that I skipped was on the importance of the long-term horizon that Professor Osborne was mentioning in his talk. So what I wanted to do in this paper is to look at the effect of short-term pay on a CEO's decisions. So you might think, well, a way to look at that is to look at, well, when a CEO sells his or her shares, does he or she cut investment? But that's a correlation. It's not necessarily a causation. It might be that, okay, the firm's prospects are bad. If the firm's prospects are bad, the CEO sells her shares, and she also chooses to cut investment because you don't want to invest if your prospects are bad. So what we needed to do is to do something to get to causation. And so what we looked at was equity vesting. So what do I mean by this? So let's say 3 years ago, in February 2018, I was given some shares with a 3-year vesting period. So that means that I have to wait 3 years before I can sell those shares. Now, the lockup expires in February 2021, and typically CEOs do sell their shares when they vest. Why? Because they want to diversify their risk. And so what we found was that in quarters in which the CEO has a lot of equity coming due, they typically cut research and development, they cut capital expenditure, and they just meet analysts' earnings targets. So that means that they focus on the short-term financial factors, not the long-term stakeholder factors, which are important for the company's shareholder success in the long term. So this suggests to the extent to which we want to reform pay, it's not so much the level of pay that matters, but the horizon of pay.
That's a very interesting point, Professor Edmans, and I've grappled with that on the whole issue of the LTIP versus the short-term incentive plan, and what kinds of programs exist that encourage long-termism within compensation arrangement. And what we find is if you put some directors, and I don't know whether or not your study looked at this, on a 10B1 plan, where they can trickle out their shares over time and agree to it, whether or not that mitigates the risk both to him or her, or the signals that the market might get as to whether or not there is no capital being allocated to projects all other things the same by trying to isolate this variable. This is ad hoc, but it would be something worth investigating, and seeing as how you're working on that paper. What does a 10b1 plan do as a variable? Do you get the same effect, or does it actually take out the risk that long-termism in capital allocation is compromised?
Yeah, thanks very much, Professor Osborne. I think that's a really interesting point, and particularly if the 10b1 plan leads to not this lumpiness, but your sale is being
smooths
spread
it
out.
Yeah.
Yeah, so whenever you have lumpiness, what you have huge incentives to boost the stock price if you're selling a lot of equity at one point. Whereas with 10b1, you pre-announce this, and you say, well, I'm going to sell at some certain point for liquidity reasons. And if that is indeed spread out, that's going to avoid the lumpiness, which causes you to want to manipulate at one particular time. Thank you very much for that. Professor Murad, there's a question on the chat. That's probably for Professor Osborne to answer that one.
Okay, let me put it up. Can you see the chat, the question?
Yes, I can see the chat.
Okay.
So given it's on diversity and inclusion, I think you're probably best to answer this.
Yes, okay, it was flickering. I got it right now.
Diversity and inclusion, I just want to put
Yes.
mention something.
Yes.
Well, we know that, theoretically that diversity is supposed to contribute to deliberation, which helps directors meet their fiduciary duty with regards to deliberation and the business judgment room. So from your experience, have you seen that diversity and actually work and contribute to that? And
yes.
And is it and what percentage of that is gender or racial diversity or geographic background or age diversity? Can you maybe just shed some light on that?
Sure, I'd be glad to do that.
Here we don't have any yet. We don't have that. It's not on our radar. We're still a growing economy, so it needs to be a long-term goal that we need to build to, because we don't want to have tokenism. So we want to avoid.
Well, let me say this. You have to start somewhere. In my view, what you want to have in a board is a diversity of opinion. So to me, and that comes from people that have different ethnicities, different life experiences matter if you're going to have what I call cognitive diversity. That is what you're looking for in a boardroom. You really want folks, not everybody needs to nod their head and agree with what's being proposed, but you need to have healthy discussions, particularly when you're talking about allocating capital to project A or project B, and project B might be, say, buying back stock, which is always a signal that maybe there aren't good fortunes or good projects available on an organic basis. And so all of that has to be taken into account. But the numbers are not very good. In California, we have 2 laws now, where at the level of the boardroom, there's a strong effort to improve the number of women in the boardroom, and it has happened, and the numbers are moving up, but they're still less than 25%. And the underrepresented minorities are also being asked to be on board. And those numbers, the Latinos and the African Americans, are still low by these standards. In a couple of the boards I'm involved in right now, I'm engaged in the whole question of repopulating and refreshing the board owing to retirements. And our priority is to try to identify directors who come from these classes that have, aside from competencies, this sort of skills that will make them collegial and contributory into the boardroom. So yes, it's happening, but it's happening slowly. I hope that answered your question, but I believe that the big issue here is people will say, well, we don't have enough to choose from. Well, part of that means that you need to do something about inclusion on the professional ranks. We see that with people from these groups, women and minorities getting better educated. They're going to fine schools and so on. They're developing careers that will allow them to that. But I think it's very important that you have diversity in the management and in the business ranks so that people get comfort with changing the culture. And that's the problem of the tectonic shift that we have in this country right now, that's represented by the political climate, where there are those that are not necessarily excited about what the long-term trend looks like in some issues, and are objecting.
Could I chime in a little bit here? I think this is a really important question. Obviously, Professor Osborne has much more experience of this at the boardroom level than me, but I'll try to chip in a little from the committees that I sit on. So I sit on the Responsible Investment Advisory Committee for Royal London Asset Management. So we run a number of sustainable investment funds. And I really endorse the importance of diversity of thinking. So it just so happens that the 4-person committee has 2 Asian men and 2 females. So we have both ethnic and gender diversity, but what really matters is not that sort of I'm Asian, but that I am a professor. We also have there an investor. We have also an ex-corporate person who was the general counsel of Unilever and an environmental specialist. So it wasn't just ticking the box of having females and minorities. We have a diversity of backgrounds, but also the procedures that we go through try to encourage a diversity of opinion. So one of the things that the committee does is that if the fund wants to invest in certain companies, it will assess its ESG record and say whether it should be included or excluded. And we have the briefing note, which has all the analysis of the analysts, which we will read and then scrutinize. Now, it used to be the case that the analysts started by saying, we think that this is an include, and then sort of gave all the reasons, and some were pro, some were against. And then overall, yes, it's an include. But then that automatically encouraged us to anchor on the original recommendation. So if we see that the analyst has said, I think it's a yes, or I think it's a no, then we read the rest of the report bearing his or her decision in mind. So one of the small things we did was just to change that so that we still have the decision, but that comes right at the end. So we've read the entire report with an open mind, not bearing in mind what the analyst thought of, and then we say at the end whether we agree or disagree. So there's a few things like that in order to try to encourage cognitively diverse views.
Thank you, Professor Alex. I have another question on ESG, since we're talking about this. What type of ESG disclosure regime would you like to see that would be, required of corporations to make the disclosures to allow the asset managers to make their evaluations based on that?
Sure, I'm happy to take this first. So I think the problem with the regime, so I know that there's a lot of call for harmonized metrics. And so the World Economic Forum has just proposed this set of metrics. And I know that investors do like something which is comparable. But the issue with that is that there are many ESG issues that are not comparable, because what ESG involves should be specific to a company. So this is the point of the materiality study that I mentioned. So there are companies, let's say Olam, which is the Singaporean agribusiness, they will measure the income uplift to the smallholder farmers. And if you're a retailer, human rights and the supply chain, those are really important issues. So I think it should be certain things which are tailored to a specific company's purpose and ESG risks. There are certain things like climate, where carbon emissions, they do matter across the board. And so I do think there are some universal things, but I also do think there are some particularly tailored metrics that companies should say, well, this is our purpose. These are the ways in which we're going to measure it and report on it. And so we need to make sure that some things are tailored, even though the trend towards one size fits all is often quite compelling for some investors, because it leads to more comparability.
Thank you, Alex. And one final question, Al, you talked about staggered boards. What we have here in Saudi Arabia is only staggered boards. I mean, would you like to, is it healthy to move towards where you get, half the companies because once you get more activist shareholders, they definitely like to have annual elections. And they do, put some more discipline or more pressure on management. But I can see that, insulation that a staggered board gives you, like, to be more long-termist instead of short-termist, it gives you that relief. Is it a case-by-case basis? What are your thoughts on that?
It's a very good question, I'm sure. And I have believed that on balance, it's an individual thing. And it really depends, as you look at all of these factors, on the purpose and performance of the company. It is quick to say that a staggered board doesn't allow for the right kinds of investments in growth and innovation, or there are lots of reasons why it can sometimes work. So you have to be careful with how you, and it's hard to sort of say it's a bad thing or a good thing, because there are a lot of flaws in most of the studies that look at this thing. But I will say this, it's like the other issue that is often compared to it is, should you have an independent chair? Or should the CEO be the chair? There's been, and I remember when Harold Williams was chairman of the SEC back in the middle 70s, and he was the first person to propose that you ought to separate the chairman from the CEO. And unfortunately, he died and it never happened, just recently. I make that point because it's the same kind of story. It all depends on the set of variables that you're looking for. But I do believe in activist investors. I do believe that investors who want to do the right thing can have a constructive role in disciplining management through what's happening to market value of the enterprise. But if the good ones are actually encouraging long-termism. So I support the BlackRocks and the Vanguards, and I've talked to these folks on some of the companies I'm involved with, because I think they're doing the right thing. So it isn't the structure so much of staggered boards. It is really the quality of the outputs. And if the company is doing very well, nobody cares. And if it's meeting its environmental commitments and the things that it said it would do, nobody's going to care that it's a staggered board. I'm in a board where we have a designated agreement with labor, for example. People say to me, how the heck can you have a board with labor as part of the governing body? Well, it's worked out quite well in our regard. It's all about, and I think Professor Edmans said this, it's all about getting thinking around the issues that are going to affect the ability of the firm to do what it was created to do. And stakeholders matter. Let's not kid ourselves in that whole enterprise. And so therefore, don't be too hung up on the fact that many of your boards are staggered. Now, if staggering is to protect a way of thinking, and there's no capital and no invention and no growth, and people are abusing, and the society is closed, then that's not good. If you really think about these issues, anyhow, I could go on, but let me stop right there.
Okay, thank you very much. I think the audience here wants to receive their awards. So definitely would like to thank both of our distinguished keynote speakers, Professor Alex Edmans and Professor Al Osborne, for giving us some of their valuable time and insights over here, sharing it with us. I think we've all greatly benefited from this. And definitely everybody who's here, please leave your business card so we can make sure that we get you a copy of Alex Edmans' book once we clear it from customs. Thank you.
Thank you.
Thank you so much.
Thank you, Dr. Mashhour. All right, thank you, Alex. Thank you, Alfred. And now we go to the what many of you have been waiting for, and we don't want to be that late. And I call on our president, Dr. Mohammed Al-Yazid, to come in. And what we're going to do now, as your name comes up, please join us on the stage, take the award, and shake hands with our president. And at the end, inshallah, we'll have the joint picture on this stadium. I always call this the best for last. However, I think we have an excellent two speakers who enlightened us on the latest on corporate governance. And as was demonstrated from the data, as well as from the speakers, good corporate governance indeed is profitable. And alhamdulillah, the culture of corporate governance is growing in Saudi Arabia. And I do believe our center played a role in that, in addition to CMA, which we thank our colleagues in CMA also for enhancing this process. And we hope this culture will keep going, and you will continue to support our center. The center provides a lot of services. You have the agenda, you have the brochure on the back page. There are some of the services which the center provides. Please feel free to join us, and we'll go from there.